Bloomberg Audio Studios. Podcasts, radio, news.
Welcome to the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. In a moment, we'll look at one jurisdiction that may be benefiting from U.S.-China trade tensions. We'll be speaking with Bloomberg Opinion columnist Shuli Ren on that. First, the churn of the U.S. equity market in the last session. That was after Moody's ratings downgraded the credit rating of the U.S. late on Friday. Now, a number of market strategists called this a non-event since both S&P Global and Fitch made similar adjustments years ago. We heard earlier from Jim Milstein. He is the co-chair at Guggenheim Securities. He told us Washington could be headed for a, quote, fiscal disaster if a recession were to hit.
You know, in the last 5 or 6 recessions, the budget deficit actually blows out because tax revenues go down and spending increases, so-called automatic stabilizers. So what today is 6.4% of GDP as a deficit, $2.4 trillion deficit, could easily expand to $4 trillion.
That is Jim Milstein, co-chair of Guggenheim Securities. Now, at the same time today, Moody's cut its ratings for deposits at some of the big banks. That would include Bank of America, JP Chase, and Wells Fargo. Not surprisingly, we had weakness in a couple of the bank stocks today. But a number of strategists said any pullback in the equity market could be a buying opportunity. So at today's low, the S&P was down 1%. And indeed, the dip buyers seemed to emerge. The S&P ended the day higher by 0.1%. Joining me now for a closer look at markets is Rob Williams. He is managing partner, also the chief investment strategist at Sage Advisory Services. Rob is on the line from Austin, Texas. Rob, good of you to join us. What did you make of today's price action?
Just a lot of what we've seen, the ebb and flow of pessimism and optimism. The markets, have largely kind of decided to call a little redo for the year. Once we had a little de-escalation in the China trade situation, recession odds have, fallen back. Markets have recovered. But yet, I think a lot of people know we're still probably a little worse off than when we began the year. So it warrants a lot of caution, I think.
Are you troubled at all by the Moody's downgrade, or is that really something that's already been discounted by the market, given the fact that S&P Global and Fitch have already in prior years made similar moves?
Yeah, it was largely, it's the third one, like you said, so it was largely baked in, a little bit, so I don't think it's going to have, it's not a good thing for the medium term. We all know we're going to have to continue to live running very high deficits relative to GDP, which is not a great thing. I think it's medium term, it doesn't change our rate outlook. I think near term, it does just put some near-term pressure and maybe some steepness to the curve. But I think medium-term rates, we still think rates go down and the Fed gets active later in the year, on economic weakness.
It's very interesting. Today, the head of Switzerland's central bank gave a vote of confidence to the U.S. bond market, saying there is simply no alternative to them. Does he have a point?
Yeah, look, we're still the reserve currency. We're still the largest bond market. We're still the safe haven. But like I said, things are rockier here. I think people also realize we're not invulnerable. Recession odds are still significant. Trade is going to be a drag on GDP for sure. Job cuts will. The volatility in policy decisions has increased. So I think I think it's the bear case for the dollar is on for the medium term. But I think rates, it's a different story. I think they won't continue to rise because I think, some of the soft sentiment data will start bleeding through to the hard data, and the Fed will have some latitude, later in the year to start easing.
So I hear that when it comes to the growth story, but what about inflation? Because today, Jamie Dimon, the head of JP Chase, was saying the chances of elevated inflation and even stagflation are greater than people think. I'm wondering what he sees that maybe the market doesn't see at this point.
I think he sees what the Fed is worried about and why they're trying to be patient in a difficult situation is, they're going to be some impact on the good side of inflation. It won't be like COVID and the supply chains break down, but goods inflation is going to go up, right? The hope is that, or not maybe not the hope, but at least weaker economic activity is going to lower the service sector inflation. That's been the sticky part. And I think sentiment's getting bad. Guidance is hard to put out there. I think the service sector weakness offsets some of that goods inflation in it. And that goods inflation is somewhat temporary. At least that's the Fed's view. But temporary still means some ugly numbers, in the future, at least some ones that look more inflationary. And I think that's what he's referencing.
We heard from the head of the Atlanta Fed today, Raphael Bostic, and he was saying that his expectation is that the Fed will deliver one rate cut this year. The market right now, I think, is leaning toward maybe 2 25 basis point rate cuts. Where are you right now in forecasting the Fed's move between now and the end of the year?
Well, it's interesting. We've been probably two since the beginning of the year, even when the market got all, frothy over, recession and more cuts. It's kind of come back the other way. It's easy to get paralyzed short-term volatility, but I think they're going to go for one or two later in the year as some of the data weaknesses, right? We're going to have drag from tariffs. We have job weakness. There's going to be some negative feedback that we haven't felt yet on the data.
So if you believe directionally bond yields are headed lower, I'm imagining that you don't believe that there is going to be any stress that gets built into the balance sheets of the big banks. I mean, today we had Moody's cutting ratings for deposits at some of the big banks like Bank of America, JP Morgan Chase, and Wells Fargo. I mentioned that a moment ago. When I kind of read the note yesterday from Moody's about the overall downgrade and the risk that was inherent in the messaging that maybe U.S. yields could push higher, I remembered what happened with the Silicon Valley Bank debacle and how that stressed a lot of the regional bank balance sheets. But you don't see that as being at all a risk going forward, do you?
No, I mean, we like the banks both in credit and equities, honestly. I think you can carry some of the same theme through your credit side of the portfolio and the equities. Banks have been largely improving their balance sheets, since 2023 banking crisis, right? And then we're sitting in a favorable regulatory environment. And so I think they have some earnings tailwinds, right? And they don't have supply chain risk. They have the tailwinds on the earnings side, and they have the deregulation story. So I think volatility is fine, but we like the banks both within credit and equities.
Today on Bloomberg, we heard from the co-chair of Guggenheim Securities, Jim Milstein, and he was saying that lawmakers are risking a fiscal disaster if a recession were to hit as they kind of move forward with this package of sweeping tax cuts. Does he have a point?
Yeah, I mean, he does have a point. I think, like I said, I think the markets and perhaps the policymakers have sort of called a redo, and they're kind of taking this let's wait and see approach. And whereas we're seeing some of the soft data has collapsed and some of the job cuts haven't been felt and rippled through the system. And look, with tariff, everyone's excited about China and going from 145% to 30%, but the effective tariff rate for global goods coming into the U.S. is still in that 13, 14%. So that's multiples of where we were. So I think there is I think the economy is going to stall, and to dump a huge spending package or a poorly thought out package is not a good thing.
So if stall is your base case here, is it too much to say that we could see a recession, or is that not quite kind of where you're forecasting things?
It could easily happen, because I think we were already, not us, but consensus in the beginning of the year was already going to have a couple quarters of very low growth, sub 1%, 0.5%. That is pretty much stall speed. So you have anything that ripples through that is a little bit worse, and you could easily hit a couple negative quarters. But I'll call it stall it, because it's either slightly negative or close to zero. It's basically the economy stalled. And I think rates are more priced for that, and equities at a 21 plus PE are not quite, ready for that reality, I think.
So if stall may be the new reality, let's get back to the financials. Why are you so bullish?
Well, like I said, I still think, they're on the credit side, they're not super cyclically inclined, right? So they're still somewhat defensive on that side, and yields are attractive, and their balance sheets are very strong. So I think you want something that can weather, a slowdown from the balance sheet perspective, right? I think you want to minimize Anything that's got obvious exposure to the policy that's going to be driving this in recession, like trade policy and job cuts, that would be, consumer cyclical. I think that'll get worth. Healthcare, we're certainly worried about. Anything in the supply chain like autos. So I think it's a better place to be is in banks, utilities. Certainly, utilities are low beta, but they also have that AI-driven, infrastructure spending behind them. I think it's they're better off than a lot of sectors from a balance sheet perspective.
Okay, Rob, we'll leave it there. Thank you so much. Rob Williams is managing partner, also the chief investment strategist at Sage Advisory Services, joining from Austin, Texas, here on the Daybreak Asia podcast. Welcome back to the Daybreak Asia podcast. I'm Doug Krisner. So markets are still being challenged with having to navigate the effects of the U.S.-China trade war. At the moment, yes, there does seem to be a little less anxiety given the recent temporary truce. And some analysts are saying the probability of recession has been reduced. But what about the beneficiaries of this trade skirmish? Have there been any? Well, Bloomberg Opinion columnist Shuli Ren has identified one, Hong Kong. Let's get her insight now. Shuli joins us from Hong Kong. It's always a pleasure to chat with you. You're such a thoughtful columnist, and you're writing that Hong Kong is finding its footing again in spite of the fact that we've got this trade war between the U.S. and China. What's happening here?
Yeah, it's ironic, right? Because you imagine Hong Kong being a part of China would be caught in this U.S.-China trade war. It's a major re-exporter of Chinese electronic goods, and Hong Kong has a lot of political issues. The 2019 pro-democracy movement didn't pan out very well, and there are a lot of political dissidents. So it has been on the bad side of the United States. And a lot of people think Hong Kong has lost its status as a prime financial center. But ironically, I think Hong Kong is finding its footing again because now Hong Kong can actually provide financing to Chinese companies that are eager to go abroad and become multinationals.
Where is this foreign capital coming from? Is it coming from countries other than the U.S. right now?
Yes, interestingly, because of President Donald Trump's unpredictable policies, a lot of global investors, especially in Europe, they're looking for Plan B, right? Like the so-called "Sell America" narrative is picking up pace, and people are trying to find alternative growth models, and they are seeing that some Chinese companies that are willing to go abroad and localize and build factories abroad, they might have a new growth trajectory. And that's why they're coming to Hong Kong.
So we're talking here about companies that already are established looking for additional capital. I'm curious as to whether or not there are new issues coming to market in Hong Kong. How's the IPO market right now?
Ironically, it's heating up. I mean, today there is a new stock being listed in Hong Kong. It's called CATL, CATL. It's the world's largest EV battery manufacturer, and it just raised $4.6 billion. Next week, we'll have a biotech company called Jiangsu Hengrui coming in, and it's raising $1.3 billion. And these are big IPOs, even on the global scale, right?
Is everything related to some form of electronic technology, or are there other industries that are joining in on the party?
I think people are looking at the so-called manufacturing 2.0, right? There is electronic 2.0, such as electric vehicle makers like BYD, CATL. But there is also the so-called biotech 2.0. For instance, Jiangsu Hengrui, the company that's going to go public in Hong Kong next week, they are telling that story. They are actually developing drugs quite fast. And the idea is that they will build the R&D centers overseas and sell their drugs overseas as well.
So you're talking about how Hong Kong is benefiting from this flow of foreign capital. Ultimately, it's going to make its way to the mainland here. What's the effect going to be when it reaches China?
I think all the capital raised in Hong Kong actually will stay in Hong Kong and overseas because I mean, it's no secret that China's economy is not doing so well. All these companies, they're really ambitious. They don't want to develop further in China because they think that the economy has saturated. What they want to do is to use this capital raised in Hong Kong outside the mainland China and reinvest outside of mainland China as well, especially, say, in Latin America, Europe, and Southeast Asia.
So I stand corrected. On the mainland, obviously, there is the issue of overcapacity when it comes to manufacturing. Different story, I'm imagining, when it comes to Hong Kong, right?
Yes, and the reason why all these, like all the global investors are liking these companies that are wanting to become multinationals is in part because Chinese economy is doing so bad. And because of the hyper competition at home, these companies have become really good. Like, I mean, if you're always racing for the last bit of dollar, you become highly competitive as well. And as a result, they think when these companies go abroad, they will kill the global internationals. For instance, we have already seen that BYD, the EV maker, right? It's outpacing Tesla.
So I'm imagining, listening to you, Shuli, that this is a good time for the investment banks that are established in Hong Kong, right?
It's better than before. I mean, for 3 years, investment banks had no business. Now they have some business, but these Chinese companies, they are also very how to put it, like a very thrifty, right? They know they're hot IPOs and they want to squeeze the investment banking fees. So yes, I have heard bankers complaining that they're not getting so much fees and whatever, but at least you have some business, right?
What about for the exchanges in Hong Kong that trade equities? How is their business performing?
That's doing well. It's kind of like the rest of the world. It's doing pretty well. Like Hong Kong stock market, the Hang Seng Index is up 15%. The cost of margin loans, the cost of financing has tumbled to just 0.4% from 4% at the beginning of the month. It's doing pretty well.
When you talk to people in Hong Kong about the weakness on the mainland, what are they saying? Are they optimistic that things will begin to turn around and maybe Hong Kong can benefit from a resurgence in Chinese growth?
I think it's hard to find somebody who's optimistic about China's economy right now. It's very hard. But on the other hand, I would also like to say the relative reference point is important, right? Like China 10 years ago was growing at 10%. Now it's growing at 1%. So people feel that the economy is really, really bad. But how bad is it really, like compared to, say, some parts of Western Europe, right? I think everything is relative. But I really still think that I have not heard anyone telling me the economy is going well.
Well, we just had the monthly activity data for the month of April the other day. Industrial production topped estimates, but retail sales disappointed. So it's really a story about continued weak sentiment among Chinese consumers, right?
Yes. Chinese consumers, some of them have money, but they are a little bit cautious and they don't really want to spend.
All right, we'll leave it there. Shuli, it's always a pleasure. Thank you so much. Bloomberg Opinion columnist Shuli Ren joining us here on the Daybreak Asia podcast. Thanks for listening to today's episode of the Bloomberg Daybreak Asia Edition podcast. Each weekday, we look at the stories shaping markets, finance, and geopolitics in the Asia Pacific. You can find us on Apple, Spotify, the Bloomberg Podcast YouTube channel, or anywhere else you listen. Join us again tomorrow for insight on the market moves from Hong Kong to Singapore and Australia. I'm Doug Krisner, and this is Bloomberg.